Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. Corey and Chad here, your hosts for this weekend's edition, also your hosts on our website, podcast, YouTube channel, and Substack account, covering daily market moves, including resource market moves, and a lot of company updates, mostly focused in the resource sector because, well, there's a lot of companies that have money that are doing a lot of work right now, and it is broadly drill season. So be sure to check out all of those channels to get our daily editorials and the full weekend show interviews. This weekend show going to be focused on the resource sector, starting off with comments more on the equity side of things and wrapping up on the back half of the show, more on metals prices, especially precious metals. We're kicking off the show with Matt Geiger, managing partner at MJG Capital. And Matt, we're going to be talking about a lot of M&A transactions, some royalty sales, some project sales, and some major investments really in North America from what we are seeing. Let's start off with one deal, the Minera Alamos taking over the Pan Mine from Equinox. This Pan Mine was originally in Calibre, which was then merged with Equinox. Now the Pan Mine moving to Minera Alamos. It was a $115 million deal, subject to some adjustments. Back end of that was a bit of dilution, actually quite a bit of dilution for the Minera Alamos shareholders, but they're bringing in a mine that does really change the production profile and also jurisdiction for Minera Alamos, which has their production in Mexico, now going to be producing also in the U.S. in Nevada. So Matt, your thoughts on this Minera Alamos taking the Pan Mine into itself?
Sure, and good morning, gentlemen. Good to be joining you. Yeah, this has generated a lot of chatter online. You know, less of a big deal for Equinox. I think the deal makes sense from their perspective. You know, they're going to be getting $90 million US in cash, another $25 million US in Minera Alamos shares. Equinox has been pretty clear in its messaging that they're going to rationalize their portfolio and focus on some of their larger scale assets. So this is not a particular surprise from an Equinox perspective. I think a good deal from their perspective, but $5 billion US market cap company, it doesn't move the needle all too much for them. On the flip side, it's a transformative acquisition for Minera Alamos, a huge deal for that company. I will say I do have real sympathy for longstanding Minera Alamos shareholders, where just when it felt that the share price was in the process of a re-rate, had been performing very well in recent weeks. This deal does come largely out of left field. Again, less of a surprise for Equinox, big surprise from a Minera Alamos share price perspective. And it really drops them, back to the levels that they were trading just this spring. A few different thoughts on the deal. I mean, I will note there's been, quite a vocal outcry from existing Minera Alamos shareholders in light of the transaction. And even with the drop in share price below the transaction price of 35.5 cents. That's, of course, the price where Equinox will be receiving its shares, and also where Minera Alamos is raising $110 million Canadian. So even in light of the outcry and the decline in share price below that level, I do think it's too early to definitively, draw a conclusion on this deal or to declare it a mistake. I mean, at this point, in a somewhat perverse sense, the longer it takes now for the permits to be received in Mexico, the smarter this deal will look in hindsight. So if next month we see permits start flowing in Mexico, I think this will go down as a mistake, certainly. In hindsight, if we roll around 2027 and we're still in this holding pattern, both from a Minera Alamos perspective and for other companies operating in country, then I think this deal will start to look smarter. And, if you want to give the board the benefit of the doubt, perhaps there was signaling received from regulators in Mexico or folks in the know within the country that no permits are forthcoming for the foreseeable future. And I think this transaction would make more sense if that were the case. And second, I would say that the decidedly negative market reaction, at least that I've perceived. I think it has less to do with the transaction itself and more to do with the pricing that was agreed to. I get that you need to leave some meat on the bones for the institutional shareholders that are coming in here, in the $110 million financing. That's a lot of money to raise in relatively short order. But the 25% discount to the 47-cent closing price that Minera Alamos achieved the day before this deal was announced. I mean, that's steep. That's definitely steep. And then there's also the inclusion of the full warrant. That's a full 3-year warrant priced at 70.5 cents. I do think if the transaction and this associated raise was priced at, maybe 40 cents or in the low 40s, that'd be closer to a 15% discount. Even if the warrant terms had been improved and maybe the exercise price had been reduced, I do think there would be less vocal opposition to what we've seen. But again, jury is still out. The bull case for this is there are quite a few very recent examples of smaller development stage or small producing juniors taking on more mature assets and seeing significant re-rates and on the back of that. Discovery Silver's, the name that comes first and foremost to mind. Andean Precious Metals is another one. So we will see how Minera Alamos responds here once the money is raised and the dust settles on this deal. But it's definitely generated quite a bit of chatter online.
Well, Matt, we did have Jason Kosek, the new chairman, on the show just last week to unpack it for investors. And I think it's important to also note that it wasn't just the Pan mine that was being acquired. It was also Gold Rock, which is a development project in Nevada, very near Pan, that could essentially double or more than double the production out of that area. I think right now Pan is doing 35,000 to 40,000 ounces a year. They believe that Gold Rock will do about 55,000 ounces a year. So a lot of people are only focusing on the producing asset and maybe missing the forest for the trees on the development asset that is the future of development there. The other thing is Jason highlighted a better cost of capital for the company on their development projects, the ability to get a better price to NAV ratio because of being a producer. And some investors, especially institutional investors, just won't touch a single asset, single jurisdiction area. If it was just the residual leaching from Santana in Mexico, that's not enough to bring them in, but they would come in if they can see a multi-pronged approach. So I guess the question is, do you see the value proposition? And yes, there's dilution, but it's on a more valuable company now because it's not just Pan, it's Gold Rock. And it's also the ability to get not just re-rated better as a producer, but some like you highlighted, not just Discovery Silver and Andean Precious Metals, but we saw it with Heliostar. We saw it with Integra, and Integra is where Jason came from. So he's doing the Integra playbook at Minera. What are your thoughts as far as that kind of a process?
Yeah, I mean, I think the three key variables here and the variables that will determine 6, 12, 18 months from now, looking back on this deal, whether it was the right decision from a Minera Alamos perspective. The first, as I mentioned, is the timing on those Mexican permits. If those are received in relatively short order, I think that makes this deal much less likely to be viewed as a success. The second, as you note, is the success that the company has in developing the Gold Rock development project, which is within a stone's throw of Pan. And then also, more broadly, the exploration potential that exists between the two assets that are being acquired. Equinox says there's exploration potential. Minera Alamos says that there's acute exploration potential. The proof will be in the pudding when they get going and start drilling. And then the third, of course, is the gold price. I mean, if we see a 30% jump in the gold price in relatively short order here, the odds are that this deal is more likely to be viewed favorably after the fact. So between timing of Mexican permits, exploration upside at the two assets being acquired, and the gold price, I think those are the three different variables that come top to mind.
Matt, how do you go about valuing a company like this now that has more development projects? And to Jason's point, should lower their cost of capital, I guess, post this transaction and this fundraise. But when it comes to more development assets, but also an asset in production, how do you go about valuing and then discounting the time aspect of developing these assets?
Yeah, I haven't sharpened my pencil myself on these different assets, but I would do it on a sum of the parts basis. I would look at Pan individually. I would look at Gold Rock individually. I'd look at Copperstone individually, and I'd look at the three Mexican assets individually. and then see where we end up. Naturally, Pan, you can value closer to 1x project NPV, and then you have to determine the appropriate discounts for the non-producing assets to reflect for the fact that they may not be permitted or they may not be technically feasible. And so that requires a lot of discretion from an investor perspective. I mean, of the non-producing assets within the portfolio, I think Copperstone is the one that probably deserves the least discount, just because there is a near-term path to production there. The capital outlay to get that up and running is relatively modest. And very crucially, it's, a past producer with very minimal permit revisions necessary. I think it should be fully permitted by the end of the year if the company's stated timeline, remains intact. So I would look at each asset individually and then see where it squares out relative to the company's newly adjusted share count.
Yeah, I think it's important to also consider Copperstone, which hasn't gotten as much airtime during this. That didn't happen that long ago, that acquisition, and it's actually the next mine up for development. So if Cerro de Oro gets its permit, of course, it could be developed in tandem, but the company has stated publicly that the next mine to build is actually in Arizona at Copperstone. What do you think about the jurisdiction diversification angle? Because when they made that transaction in Arizona last year, we had Doug Ramshaw on, the president, and he mentioned this is not a pivot away from Mexico, but it does boost our jurisdiction profile. That same messaging came out from Jason on this. This is not a pivot away from Mexico, but we're just expanding into Nevada, which is obviously seen as a good jurisdiction. Do you think that helps the company attract a different caliber of investor that maybe wouldn't touch Mexico, but would be happy with Arizona and Nevada, especially with all the administration tailwinds for developing mineral projects in the U.S.?
Yeah, perhaps. I mean, it's been an incredibly rough 6 or 7 year period for Mexico. There are folks in my network that won't touch the jurisdiction, really irrespective of the project or the group that's operating it. As it stands, we have minimal exposure to Mexico within the MJG portfolio. But given the right opportunity with the right team at a reasonable valuation, I'm not ruling out the jurisdiction entirely. But it's really been a no-go zone here for a number of years. So, I guess you could quibble over whether it's a full pivot from Mexico. I don't think it is. I think a substantial percentage of Minera Alamos's NAV as a company remains in Mexico. But it definitely is further diversification outside of the jurisdiction. And I think given where the amount of money that's being raised and the price that's being paid for these U.S.-based assets, if you had to classify Minera Alamos, it is more of a U.S.-based company than a Mexico-based company as it stands.
Well, we'll maybe follow up on this deal, maybe a year down the road, just to see, because as you said, time will tell, especially when it comes to the Mexican permitting situation. On to the next deal. Altus Minerals selling 1% of the NSR at the Arthur project to Franco, Nevada. This is $250 million in cash plus a contingent cash payment of about $25 million. Your thoughts on this deal? I think you were on the show not long ago saying that this could actually be happening, and now it did.
That's right. I mean, in our recent conversations, there's been a lot of talk about the royalty and streaming space. And, just to reiterate, it's been an extremely exciting period, really over the past 90 or 120 days. Of course, it all kicked off with Origin being taken over by Triple Flag, largely for its 1% NSR over the expanded Silicon project, which has now been rebranded to the Arthur Gold Project by the operator there, Anglo Gold. That was followed in pretty short order by Tether in the high-profile news that they were taking a controlling interest, now above 50% ownership of Elemental Altus. Of course, in early July, we then got the news that Royal Gold was taking out Sandstorm and Horizon Copper in a joint transaction there. And I think we spoke shortly after that, and I mentioned that there's more shoes to drop, and the two most likely things, at least as I saw it, first was Altius transacting on its 1.5% royalty at the Arthur project, and then alternatively the potential of a tie-up between OR and Triple Flag. No news on the OR and Triple Flag front, but the Altius news did come to pass. I think that was fairly predictable. CEO Brian Dalton had been quite clear to the market that the company would be coming to a decision on how to proceed there by the end of Q2. They didn't press release the news until late July, but they were largely on schedule there. And look, from a high level, like as a long-term Altius shareholder, I view this as an excellent deal for the company. They're really realizing significant value for what had been just a few years ago a non-core asset for the company. And then they're also keeping 0.5% NSR on the asset for additional upside. So the transaction, they sold 2/3 of their 1.5% royalty to Franco for US 275 million, or that's approximately 375 million Canadian. In terms of the pricing that was paid by Franco, the 375 million Canadian is roughly a 9% premium to where Origin sold its 1% NSR to Triple Flag. And that makes sense because the gold price, the spot gold price, at least through the day that Altius announced its deal, had increased by about 12% since the day that Origin accepted the Triple Flag offer. So it's not a surprise that there was a decent premium to where that transaction took place. And despite my satisfaction with the transaction, as an Altius shareholder, I actually wasn't quite sure how the market would react to the deal, as there was speculation in some quarters that Altius potentially as a whole would be taken out by one of the larger royalty players. And it was unclear to me how much, if any, of a takeover premium was built into the Altius share price. Because, one of the options on the table was that Altius would be taken out entirely by a larger player. I guess in hindsight, the answer was not much of a speculative takeover premium, as the Altius share price has responded very favorably in the past few weeks post this deal's announcement, actually just hitting an all-time high earlier this week, exceeding its previous all-time high going all the way back to 2007. So I think the Altius team's probably pretty pleased with how the market has greeted this deal. With all of that said, I don't get the sense that this was an easy decision at all for the Altius team, because Arthur does hold the potential to be a generational gold asset. I mean, it's at 16 million ounces as it stands. Franco is paying closer to 30 million ounces, just in broad strokes. And I think if in 5 years from now, we're at 35 million ounces and there's been no major snags on the permitting front, then perhaps Franco, may have gotten the better of this deal. It's hard to say. But Altius has always been a very conservative company. Again, this asset that was non-core just a few years ago got up to close to 50% of Altius's NAV, at least based on the pricing of this transaction. So I think it makes sense for them to take the bird in hand while also retaining, additional upside to Arthur through the 0.5% NSR that they retained. So that was very exciting to see as a shareholder.
Well, Matt, this kind of brings up the larger topic of M&A in royalty companies, which I know we've talked to you about a couple of times. And a lot of people, when you bring up royalties, will make the comment, oh, there's just so many of them, I wish there was more consolidation. And I always scratch my head a little bit on that, because while there's about a dozen or so companies, there's hundreds and hundreds of exploration companies. If there's any place in the sector that's overweight too many companies, it's the Explorcos. Royalty companies, when they go from smaller to larger, maybe get a better price to NAV valuation, and that's the argument for making the deal. But it sometimes steals the torque of the smaller mid-tier company where it would have had more upside. So, for example, the Sandstorm deal, I wasn't on the call with you and Corey last time, but as a Sandstorm shareholder, I was pretty disappointed in the 21% premium when I thought there was big catalyst coming up with Hod Maden and then eventually Mara on the Glencore project. And so when it got swallowed up by Royal Gold, you took what was a solid mid-tier, which I actually thought that would have been a good combination with those Osisko gold royalties, Sandstorm and and the Osisko together. But you've mentioned the Triple Flag and Osisko one, which we'll keep our eyes peeled if that plays out now. But do you think that these transactions, while people want them, a lot of times they keep consolidating more and more of the good companies into larger companies that don't have as much upside torque? We saw that when Mavericks was taken off the board. We saw that when Nomad was taken off the board. I think we were both happy when Golden Valley was taken off the board. But still, a lot of these smaller companies, if everybody gobbles them up and there's only a few choices left, they don't have the torque that the bigger companies do. So what are your thoughts on M&A and both sides of the equation, the larger company acquiring it, or if you're a shareholder of the smaller company hoping for more upside and it gets gobbled up by a larger one, the disappointment there?
Yeah, I mean, I'm of the perspective for the royalty space in particular that the less names on the board, the better. So I would push back against your first point. I mean, look, of course, the business model is seemingly gaining popularity with each passing year, but it's still a relatively small niche within the broader mining sector. And royalty companies are competing amongst each other on two fronts. The first front is, of course, from a deal flow perspective, trying to find that next royalty or stream to either originate or buy from a third party. And the more competition there is, the less likely you are to land the deal, or if you do land the deal, the higher the price that you'll likely have to pay. And secondly, you're competing for investors because, all things equal, the higher you get your share price, the lower your cost of capital is, and the greater prices that you can justify for new acquisitions relative to your peers. So all else equal, I think it behooves, us as investors for there to be less names on the board. And I will note that even with these, the flurry of transactions that we've seen, we're still at roughly the same number of royalty companies that we were, going back, before this flurry of activity. Origin, of course, was taken out by Triple Flag, but Triple Flag in essence was just taking that 1% NSR at Expanded Silicon, now called Arthur, with the rest of Origin, Origin 2.0 being spun out into a standalone vehicle, which has now happened. And while we have seen Sandstorm and Horizon now in the process of being taken out, we've had a couple new entrants, at least into the publicly traded space, between Versamet, which was the old Sandbox Royalties, which was spun out of Sandstorm a couple years back. That's now publicly listed as of late May, I believe. And then more recently, we've had Summit Royalties led by Drew Clark come onto the scene through an RTO with Eagle Royalties. So, even with the M&A activity, the notable increase in M&A activity, we're still at roughly the same number of companies that we were before it all began.
Matt, kind of a side tangent on that. What about all these companies that have an asset that create a royalty and keep that royalty within their company, almost as a private company, waiting to list it later or waiting to sell it later? What do you think of that strategy?
Look, I mean, it goes back all the way to Virginia Gold Mines and Andre Gamon, who parlayed that strategy beautifully with Virginia Gold Mines and then keeping a royalty that ended up being kind of the backbone of the Osisko Gold Royalties that we know today. So it had been done previously, and then in more recent times, Great Bear did that to great effect, carving out what I believe was a 2% royalty over their Dixie project, then selling Great Bear to Kinross, and then was it 6 or 12 months later, selling the royalty in another significant transaction to Royal Gold. We've seen a few other companies do it since. Vizsla Silver being one example. Nevada King, I believe, did it on its Atlanta project. And then most recently, NGEX has done it on Guanajuato down in Argentina. Look, I think it works if the asset can support the royalty. So for extremely high quality, substantial scale, good grade projects, it can make sense. And it can be a way to further capture value for shareholders. You do get into trouble, however, if the asset can't bear the royalty and it either encumbers the asset to a degree where the economics are significantly impacted, or it turns off potential acquirers that would have bought the asset and taken it forward more aggressively otherwise. So I think in the right circumstance, it can make a lot of sense, but this isn't a one-size-fits-all solution for all development stage projects that are out there, that's for sure.
Well, Matt, we also have different flavors of royalty companies. There are some that buy baskets of assets from larger producers that then develop those into companies. That was kind of the Mavericks playbook back in the day, and we've seen other companies do that. We've seen some companies that just buy one-off assets to build their company, something like what Vox Royalty has done, and they're getting them from non-traditional places where they're not really competing with other royalty companies, so that's kind of their angle to it. But a popular way that you see royalty companies develop, and this is the very model that Altius Minerals and that EMX Royalty have done and that Origin have done, is the prospect generator model, where they keep optioning off projects, they keep the royalty as their payment, and when they build up a basket of royalties, they pivot from a prospect generator into a full-blown royalty company. That's what Altius did, that's what EMX did, that's what Origin did. There are tons of prospect generators that are still doing this, so aren't we always going to have more and more companies coming onto the scene just using that doorway in?
Perhaps, but these royalties take so long, especially if you've created it yourself through a royalty generation business model, to actually gain substantial mass. So, like Kennerland Minerals is a good example with their Frotet projects. Like, I don't know at this point whether to consider Kennerland a royalty company or a prospect generator. In my mind, they're more in the prospect generation category still. So sure, with the right team and the right focus over a sustained 5 to 10 year period, you can make the transition, from a prospect generator or a royalty generator to a proper royalty company that maybe still retains royalty generation capacity. Like I think EMX, for instance, has officially made the leap. Like I think you would classify EMX as a royalty company that just happens to have royalty generation capacity built in. I think you'd classify Altius Minerals the same. Origin is kind of straddling the two different camps at the moment. They're a really interesting company. I mean, they have one producing royalty now in their most recent incarnation. That's the 2% NSR to Ermitaño. But I think you could make a good argument that they're a royalty generator that happens to have one producing royalty. But I think these take time for a royalty company to mature to the extent where it's truly grouped amongst the producing royalty players. And I think it's more likely that some of these prospect generators that do happen to find their hands on a valuable royalty, rather than them sticking around for the 5, 10 years that's necessary to make the transition to a proper royalty company, they're more likely to get an offer that they can't refuse from one of the existing royalty players to take that royalty off of their hands. So I think that's probably the path forward for a lot of these companies that happen to find themselves with one royalty. And that's really what happened with Origin as well. Like in theory, they could have kept their 1% NSR at Arthur, but it got to be such a large percentage of their NAV that they made the decision to transact when the price was right. And I can understand why they did that.
Hey, it's the dream of these prospect generators to turn into royalty companies, but as you said, it's very hard and it takes a lot of time. Just wondering how you value these royalty companies. We were talking before even recording this, and I was just looking at some of the PE ratios or even the price to just revenue that some of these smaller ones get, and it's just crazy, some of the multiples that some of these companies get. But look, it's a low cash, low drain business when you have a royalty, because it does just produce revenue for you, but you do need to be creating other royalties. So when you dive into these companies, what do you look at to actually value them to see if there's some sort of market disconnect?
Yeah, I mean it's much more difficult, but I really do think you should be looking at it from a PNAV perspective, especially for the earlier stage royalty names, the juniors, and even some of the mid tiers where a significant percentage, if not a majority of their NAV is in non-producing, pre-production assets. So it's difficult because a lot of these companies have dozens of assets, and it's not easy to go asset by asset and analyze the valuation. But I think if you want to be exacting in your standards, that's the appropriate way to go about it. If you're looking at a Franco or a Wheaton or a Royal Gold that do have, the majority, if not vast majority of their value comprised of producing assets, then you can look at metrics, such as price to cash flow, just kind of the most common earnings metric that the royalty space looks at. But I think even for those names, the most appropriate way to go about it is to look at the assets individually and see where you come out.
Matt, just one more question on the royalties. A lot of airtime was given to why they were dangerous for companies to do a royalty and that they're stealing from the future and they're diluting down the future. That was maybe a decade ago when they were first coming on the scene and getting bigger. Now you fast forward, and oftentimes companies tell us in interviews or tell us off mic that they're actually getting a lot better cost of capital from the royalty and or streaming company than they are from banks and financial institutions. And so it's become a more respected placeholder in a capital stack to maybe have some debt, some equity, and maybe a royalty or stream. What are your thoughts on the value that these companies provide to development stage projects to get them over the hump and get them developed? Because sometimes they're the only option companies have, or they're a better option that companies have.
Yeah, I mean, this may not be an entirely satisfying answer for you, but I truly do believe it's case by case. But also for, say development stage portfolio or companies that are within the MJG portfolio, I would advise management teams, if they're looking to access capital and they're considering a dilutive equity raise, to at least hear the royalty companies out. Like there's no harm in getting all options on the table, and that could be straight equity at the company level, that could be bringing in a partner, at the asset level, that could be taking on convertible debt, that could be selling a royalty or stream to one of these royalty and streaming players. And from my perspective, why not hear them out? Put all different options on the table and make an informed decision from there. And if it's a close call between an equity option and a royalty and streaming option, then I would certainly lean towards equity. But if you truly get an option or an offer that you can't refuse and can raise a significant amount of capital to achieve one or more development milestones without issuing a share, then I wouldn't, as a shareholder, throw up my hands and say that was a big mistake. So I think it needs to be viewed as one of a menu of options, and it can make sense in some circumstances, and in other circumstances, it should be avoided entirely.
All right, let's shift our focus one more time to copper. Recent deal, Hudbay and Mitsubishi Copper World project. This is an Arizona copper mine. Mitsubishi saying that they will acquire a 30% stake in this asset. Initial contribution of $600 million. Copper in Arizona, it is continuing to be the talk of the town. Now we're seeing some more funding come into the sector. Matt, what does this mean in your eyes? Bigger copper picture, especially in the US, but also for this Hudbay project.
Yeah, I mean it's a big chunk of change that was announced just earlier today. Mitsubishi, a Japanese trading house, is paying $420 million upfront when this deal closes, and then another $180 million. This is all in US dollars. Another $188 million, within 18 months to acquire that 30% asset level stake. And for Hudbay, this concludes, a minority partner process that began earlier in 2025, where apparently other trading groups in Japan, as well as Saudi and UAE entities, were also apparently interested. But it's clear that Hudbay, at the end of the day, went with Mitsubishi. Look, without being too close to this, I think it looks like a very strong deal from a Hudbay perspective. I mean, Mitsubishi is about as credible as they come in terms of a minority partner that you could bring in on the asset level. And especially with this cash injection, once the full $600 million comes in, it will firstly defers Hudbay's first capital contribution, I believe, until 2028. So it really kicks the can down the road before they're going to have to stump up any more money at Copper World. So that's a big deal. And then also, if the build cost and the recent pre-fees is to be believed, it means that Hudbay is only going to have to stump up, $200 million odd dollars to actually get this built, which is very attainable for what's now a 4 billion plus Canadian company. So really good on both of those fronts. We have no horse in this race, though. I will note we did have royalty exposure to Copper World back when Nova Royalties was a standalone company. They owned royalties over parts of this asset, but they were subsequently taken out by Metalla. But look, I'm happy for Hudbay shareholders. I mean, the market reaction, at least today, has been really strong. When I last checked, the share price was up nearly 15%. And if I'm not mistaken, this takes Hudbay's share price up to a level that we haven't seen in 12 years. So at least the initial reaction has been quite positive. And, to your question about broader implications, I don't want to overstate the significance of a single deal, But I will say it is generally positive for the US copper space. To see this deal, especially so shortly after the Trump admin's really shocked decision not to impose any tariff on refined copper imports. That was not my expectation, especially given Trump's comments in early July. I thought 50%, it wasn't necessarily going to be 50%, but certainly was expecting there to be some tariffs as had been messaged by the administration on refined copper imports. That perhaps the hangover from that disappointment will prove, not to be very long lasting. So this is good for the Ivanhoe Electrics and the Arizona Sonorans of the world in a general sense. But part of me does wonder, if refined copper tariffs had gone into place, as the market really strongly expected even just a few weeks ago, whether the pricing of this deal would have been even more advantageous from a Hudbay perspective. But again, I think, all that withstanding, this is a solid deal for the company and shareholders of that company.
All right, Matt, we've taken up enough of your time. Thank you very much for taking us through some of the really major deals in the resource sector in the recent past. There's still a lot of M&A happening here, from small companies up to the large companies, and a lot of money coming into the system and also sloshing around the system. I know it's encouraging, I think, and I know everyone's still waiting for other companies to fully get taken out, but there are deals happening, and that needs to be embraced. Again, Matt Geiger, managing partner at MJG Capital. Great chatting with you, Matt. Thank you very much for your time. Everyone, stick around. We're going to be right back to focus a bit more on the precious metals price.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report and continuing to focus on the resource sector, precious metals in particular, now more broadly just on the actual metals and price movement there, as we're chatting with Jeff Christian. Jeff is the managing partner at the CPM Group. Now, Jeff, there's been a lot of news with gold and some of the other precious metals. We've had tariff news over the last month, an executive order that looks like gold can be put into 401ks. We've had a lot of earnings out of majors. We've also seen some reports that ETF flows are really picking up in the precious metals. Again, there's still this uncertainty, I think, underneath all these markets, which has kept gold very much in a trading range, and silver has been, in a way, outperforming gold, with the stocks outperforming the metals. A lot for us to get to here, Jeff, but I know you like to focus simply on the metals, investment demand and price moves. So I'm curious, through all this noise and all this news, what have you been paying the most attention to?
Well, we've been paying attention to investment demand flows, and not only into physical metal, but also like on the futures market and other markets. And we've been paying a lot of attention to those news items, like, for example, the 401k. I'm not sure that the president has the capacity to issue an executive order allowing for that. I think it may have to go through the legislative process. If not the legislative process, definitely the regulatory process to allow the IRS and the Treasury at least have to pay to opine on that and make it happen. So, you get these news stories. That's one of them. Another one is the tariff. So there's a tariff on gold. Oh, it's a tariff on 1 kilo bars. No, there's no tariff. And, so there's no tariff. We can breathe again. And then it's like, well, can you really? Because the quixotic nature of all of these decrees coming out of Washington, they come and they go, and those tariffs can reappear just as quickly as they disappeared, or reappeared or appeared originally. So there's this tremendous uncertainty. There's extremely high risk. not only in precious metals, but across financial assets and economic assets. And you're seeing, for example, a greater hesitancy on the part of corporations to invest in new plants, new equipment, and new hires. You're seeing an increased concern about the veracity going forward of economic data coming out of various government agencies. So there's very high risk, there's very high uncertainty, there's a tremendous amount of anxiety across the financial markets, and that gets interpreted into demand for gold and to a lesser extent silver. And that's really what we've been seeing, and you have gold prices vacillating. I mean, they give up $60 one day, $100 the next day, but then they go back up $150. There's this tremendous volatility, but it's at the top of the market. And gold, you are at record prices. Silver, if you think about silver in terms of quarterly average or monthly average prices, you're pretty much at record levels for silver. I mean, so, you've got these markets that actually have performed very well, and they perform the way that investors should have expected them to. They're rising in a time of heightened risks and uncertainties in other financial markets. But there's a tremendous amount of volatility. And, it's like, is this the peak or do we go further? CPM Group thinks we go further, that this isn't the cyclical peak, but that's just our opinion.
Well, Jeff, I'd be curious to get your thoughts on when you look at, let's just say gold, we'll isolate it to that for now. The narratives that we've had out over the last few years in this bull market have continued to change, but people always like to explain away the move in the price of gold because of one silver bullet idea, to use a pun there with silver involved. But, it was the Ukraine war was causing it to spike up, and there's a geopolitical premium. And no, now it's because of supply chain issues, and then eventually it's because of the deficit and the debt, and then it morphs into, okay, now it's because Trump's going to be president. Oh, now that he's president, selling off because he won the election, and it keeps on moving. This ball goes down the field here, and we've heard all year that it's because of uncertainty, like you were just outlining, which is always the case with gold. But we've heard that there was geopolitical premium in there from the Israel spat and with Palestine, and we heard that there was all kinds of stuff in there from these tariffs, and because it was executive orders on minerals that were of strategic importance, gold's now on that list. How much of this narrative is baked into this price, and how much of it is just the trading action of people buying at higher and higher prices to diversify their assets?
I think it's mostly the latter. People are basically saying, we have a lot of clients that we had said, 5 years ago, 2015 to 2019, we were telling our clients that we thought we were at a cyclical trough in gold prices, and that the prices would probably rise very significantly in the near future, another leg up, similar to the leg that we had seen from 2002 to 2011. And so we were telling our clients, you should be buying gold, and you should be looking for the price north of $3,000 as a cyclical peak, similar to in size to the one that we saw 2002 to 2011. And over the last year or 7 months, because we really were below $3,000 until this year, we've had any number of clients, and these are wealthy individuals, family offices, and a whole range of institutional investors up to sovereign wealth funds. We've had a whole range of clients saying, okay, we're sort of at the time and level that we thought might be a cyclical peak, but we don't want to sell our gold because we look at the political and economic environment, and the individual crises come and go in terms of attention, at least. But we look at the political and economic environment and we say we think we want to hold on to our gold. But that said, hey, 10 years ago, this looked like it would be the timing and the price level for a cyclical peak. So what should we do? So we've been telling them to buy puts and stay long the physical, and maybe pay for the puts with call spreads. And what you've seen, not just in gold, but across financial assets, is an enormous surge in options being bought by wealthy individuals, institutional investors, and retail investors too. Optionality has really skyrocketed as people are saying, this may be the peak for gold, for silver, for the Dow Jones Industrial Average. I don't necessarily want to liquidate my long position, but I want to protect myself against the potential for spikes down, either short-term spikes down or cyclical spikes down. And that's what really we've been seeing for the last 5 to 7 months.
So, Jeff, carry this over to investment demand within the COT reports. Anything we should note there, but also tie in central bank. They're buying across the world, around the world. They have been huge buyers of gold. What do you see in COT report and central bank demand?
Yeah. Well, the CLT is interesting because you did see some pretty heavy profit taking a couple months ago, but the gross longs and the net long positions by institutional investors have been rebuilt. They're not as high as they were, maybe 2 years ago, and they're not as high as they were, around 2019, 2020 during the COVID thing, but they are pretty high. I mean, the net long position is around 25 million ounces right now. It was 27 million ounces on a gross short basis and 22 million ounces at the end of July. So you've got a lot of institutional investors long gold futures and options. The COT includes options they have a formula for including the options. They don't necessarily count them out for ounce. So you're seeing institutional investors pour into gold, and they're doing it in the futures market. They're doing it in ETFs, and they're doing it to some extent in the physical market as well. In terms of central banks, you've seen reduced selling or reduced buying among central banks of gold. I mean, the biggest buyer so far this year in the first half of the year was Poland, and it bought about 2.2 million ounces over the course of the first 6 months of this year. And most of that, by the way, has been stored at the New York Fed. The next largest buyer is Russia, which had 600,000 ounces. And that's gold that Russia bought within Russia to it's been using its gold to pay for its government expenditures and to prosecution of the war. And you don't see Kazakhstan bought some, China bought 500,000 ounces. So you're not quite seeing the dynamic purchases that you saw over the last couple of years. On a gross basis, central banks as a whole bought about 5.6 million ounces on a gross basis in the first half of the year. And then various central banks, Uzbekistan, Singapore, were the two big ones. They've sold about 1 million ounces on a gross basis. So in the first half of the year, central banks have bought about 4.6 million ounces. That puts them on track for 9 or 10 million ounces for the full year, which puts it pretty much in line with what we've seen for the last several years in central banks. So, I know that there's a narrative out there that central banks are buying gold hand over fist, but they're not. I mean, if you go back to 2023, net central bank purchases were about 14.6 million ounces. Last year, they fell to about 8.8 million ounces. This year, it's going to be 9 or 10 million ounces. So it's on par with what we saw last year, but it's not necessarily tremendously high the way we had seen in 2023. Now, part of that is because the gold price is much higher now than it was in 2023. The gold price averaged about $1,900 in 2023. So far this year, it's averaged about $3,100. So the gold price is up substantially, almost roughly 50% from where it was in 2023. And the central banks, as well as institutional investors, think in terms of what portion of my portfolio denominated in dollars should I put into gold, right? So as the gold price has risen 50%, you're not surprised to see that they're buying 30% less gold than they did 2 years ago.
Yeah, it's a good point. They're price sensitive, like any other buyer. And people say that they're not, but they absolutely are. And that's why we saw the biggest spike a couple of years ago when it was a better price. So, well, let's pivot over to silver, Jeff, because as the point you made as far as annual averages, this has got to be one of the highest annual averages so far in silver that we've ever seen. It's definitely on a quarterly basis, the highest quarterly average that we've seen. Where is your thoughts as far as where silver could go? People, of course, Jeff, still looking at that $50 spike high from 1980 and 2011, but I think at these levels, these are pretty robust levels. Do you think it can get up into the 40s and climb there for the second half of this year?
Our expectation is that the silver price will touch 40 within the near future. Sometime this year. And I'm not quite sure I have it in my hand. Our expectation is that the average price for the full year will be up about 25%. But, that is predicated on the idea that gold is trading around, $36 to $42 an ounce to get to that 25% increase over the last quarter of the year. So our expectation, our ultra short term view is that you've got this range of, say, $36 to $39, and silver is very volatile in that range. And we're telling our clients, our investor clients, don't buy at today's price, which is about $38.60. But if you see the price trend toward 36 or below 37, you might want to go long. And if you see the price getting up around 39, you might want to go short on an ultra short term basis. On a longer term basis, today's price is probably an interesting place to buy because our expectation is that the silver price will rise not only in the fourth quarter of this year, but through most of next year and possibly into 2027.
So, Jeff, as much as we talk about the demand side of things for silver and gold, what's the supply side looking like? Have you done any research on the supply, the metals being mined, any growth in that aspect since we are at higher prices?
Yeah, it's funny because we wound up spending way too much time correcting misimpressions about that we're running out of silver and there's a deficit of mining production relative to fabrication demand, stuff like that. Silver mine production rose about 2.5% last year, and it's on pace to rise about 1.2% this year. So silver mine production is actually rising. Secondary recovery is rising much more rapidly. This is silver recovered from all sorts of stuff, electronic goods, even solar panels are now having silver recovered from them, jewelry and silverware. And, you saw about a 5% increase in scrap recovery last year. And it looks like we'll probably see about 11% increase this year. Right. Now, part of that may be obscured by the fact that you're seeing what's really silver investment products being recycled. So you have a lot of people who, for the last several years, since about 2001, they've been buying medallions, which, you have to distinguish between official coins issued by national mints and what we call medallions or rounds, and some people call them junk silver, which are like coins, but they're not issued by national mints. And there's a big difference there. And people were buying the medallions rather than the coins because they had a lower premium. And we kept warning them, it's not the premium you pay when you're buying that counts. You have to watch out for the premium that you get or don't get when it comes time to sell. And what we've seen really over the last year and a half or 2 years now is a lot of investors who had bought these medallions and 1 ounce bars, 10 ounce bars, even 100 ounce bars, selling them. And some of these people bought at the highs back in 2021 and they're getting rid of it. Some of them bought back in 2011, 2012, and they're selling that stuff. And there's been a lot of that coming into the market. The investors are getting discounted to the spot price when they go to sell it. And then there's so much of that it's being sent to refineries to be melted down and cast into 1,000 ounce good delivery bars. So you have a backup of materials now at the refineries. Some of it is end of life fabricated products. Some of it is this investment products that are being sold by investors who are taking profits at record levels.
Well, Jeff, you touched upon what is usually a poking the hornet's nest topic here, but we're going to go into it anyways with you, and that is the supply deficit that people claim is in silver. You have long stated on the show that when you look at industrial and fabrication demand, that simply is not the case. And you just laid out there that the mine supply is actually growing, and it grew last year as well. But people continue to count investment demand in there, and that's different than how you would do other commodities. But their rationale is that there is legitimate investor demand on silver coins and bars and jewelry, so why shouldn't it count? Do you want to unpack that topic again? Because we hear from everybody there's a silver deficit, and you maintain that there's not. Maybe get into the nuances there.
Sure. And I'll say, excuse me for saying it, but we have actually addressed this issue extensively in the last 2 or 3 CPM Group YouTube videos that we've done, and we've talked about it. But the easiest way to explain it is that if you're looking at a commodity as an investor and you want to know, is this commodity in a tight supply or is it in an oversupply? You want to look at total supply, which is mine production plus scrap in the case of silver, less fabrication demand. And you don't want to include investment demand in that. And you don't want to include investment demand because when you're using silver in a fabricated product, you're taking refined silver and you're putting it into a different form that may have a radically different price value unrelated to the silver content, phones, electronics, stereos, solar panels, etc. And it's not readily available to be sold as silver bullion. Investors don't use silver. They buy silver and they hold it in refined form. So it's not being used and it can be resold on a moment's notice, which has been the case over the last 2 years. And people say, well, why are silver prices underperforming relative to gold? It's because investors have been selling refined silver into the price rally and capping it. So you want to distinguish between fabrication demand and investment demand. The last thing you want to do is invest in a market that is showing a deficit because other investors are buying it. You're becoming the greater fool. Other people are buying this and driving the price up and holding it to resell at some point because they're investors, and you're not a real investor until you've sold something. So if I'm buying into that rally, the greater fool, right? So you just don't want to do that. You want to find a market that's in a structural deficit of newly refined material relative to fabrication demand. So that's the easy intellectual economic explanation. There are other explanations, and I'll give you another one. CPM Group has been doing research, as CPM Group since 1986, but our group goes back to the late 60s, early 70s at Geiger and Company, which had a fundamental research department, which is what CPM Group is today. And we've been doing this all along, and we've always followed that Commodities 101 practice. It's, the surplus deficit is total supply less fabrication demand. And we, in the late 1980s, the silver price was coming, it had been $50 briefly in 1980, and it stepped down, and it was $16, then it was $8, then it was $5. And in the late 1980s, an organization hired us to talk to its members. And they said, why is the silver price falling? And we said, well, because investors are not buying as much as they used to. And in fact, more investors are starting to sell metal that they bought when the price was $35, $25 an ounce, and they thought it would go back up to 50, and it didn't. It came down to 7, so they're selling it. And banks and brokerage houses and trading companies are not selling silver to investors anymore. So you don't have people selling silver to investors, and you don't have investors buying silver. And that investment demand is what drives the price higher. And you want to disaggregate it from fabrication demand. So these guys came back and they said, okay, you guys have a quarterly silver survey that CPM Group produces. Can we buy the right to have a stripped down version once a year that we distribute freely so that the market has good data? We said yes. And that was the creation of the World Silver Survey. And we had a 5-year contract for the first 5 years of the World Silver Survey that gave us editorial control. And at that time, we were saying the silver market is in a deficit. Investors are net sellers. There are billions of ounces of silver above ground, and fabrication demand is strong because the price is $3.50 to $5.50 an ounce, and mine production is declining, and secondary recovery is declining because the price is $3.50 to $5.50 an ounce, and people are saying, I'm not going to mine and I'm not going to sell my old silverware and jewelry at these prices. And the sponsor of the World Silver Survey thought we were being too bearish. And we said, sorry, but that's what the analysis is. So for 5 years, we struggled with them. And then at the end of 5 years, we said, okay, we can't do this anymore. Our reputation is suffering because people are saying CPM Group is going to be more bullish than it would be otherwise because it has this deal with the World Silver Survey. So we parted company with the client. And they hired people who had never done silver research in their lives and said, do you want to take over the World Silver Survey from CPM Group because they're walking away? And they said, yeah. I said, okay, here's the deal. We want it to be more bullish than CPM Group was. And one of the ways you do that is you take investment demand and you add it in with fabrication demand, and voila, you don't have a bearish market, you have a bullish market. And that is where the practice of adding investment demand in with fabrication demand came from. It started with the World Silver Survey. The same people then did it with gold for the World Gold Council. And, so that's where it comes from. So first off, you can say intellectually, you should segregate investment demand for all the reasons I gave you originally. But then you can now also say, here's the practice. The practice is this, and this is why some people add investment demand in. They consciously did that because they wanted to present a more bullish picture than the basic data suggests.
Oh, the beauty of tinkering with numbers, isn't it, Jeff? And hey, you can usually get whatever outcome you want when you add or subtract whatever data you want. I guess before we leave gold and silver, just a reflection back, a historical context here. A lot of uncertainty around the world. That has been mentioned a number of times. Already in this interview, we mention it pretty much every week on the show. Any historical context as to where the market's at, where it has been in other points in history?
I have been saying that the amount of political and economic uncertainty that we're facing in 2025 is greater than at any time since December 1941. In December 1941, Japan attacked Pearl Harbor and the U.S. entered World War II. And at that point, everyone, I can't repeat on the media what Hitler said when he found out that Japan had attacked Pearl Harbor and the U.S. was entering the war. Everyone knew in December 1941 that the Allies would win the war. They didn't know how or when. They didn't know that it would take, 3.5 more years to do that. But they knew it was over because of the strength of the U.S. military and economy. So we're at a greatest period of time in economic and political uncertainty in 84 years. And in that environment, people will continue to buy gold and silver to protect themselves and their family, their wealth, their income from these devastating trends in national economies, national political systems, national societies, which are being torn apart by demagogues. not just in the United States, really around the world. And then the collapse of the international cooperative system that was put in place after World War II, which is being destroyed, and it's being destroyed consciously because there are people who say we can do better if we negotiate unilaterally with each country rather than saying, let us get together at the United Nations or the IMF or the World Bank and agree as a community of nations and governments how the world can work together. So you've got enormous political, economic, and social and financial problems that we just don't know how we're going to shake out. And until we know how it's going to shake out, and until it starts to shake out in a better way, investors will buy more gold and silver unless their governments say stop buying gold and silver.
Well, Jeff, I think that's a good summary of the underpinning of the value in the precious metals. Two precious metals that we don't talk about as much, and they really are more industrial metals now. Platinum and palladium have gotten a lot more interest in 2025. We saw them move out of the range they've been in. There's not a lot of people that we talk to, Jeff, that actually cover the PGMs, but you do at the CPM Group. And I'm just curious, at these levels at around 1346 platinum and 1136 palladium as we record this, these are higher levels than we've seen. Are they still a precious metal because of the bars and jewelry and coin demand? Are they really more of a story of catalytic converters and industrial demand? What is the outlook from CPM on the PGMs?
Yeah, the platinum and palladium primarily are industrial. They don't have 5,000 years of history as monetary metals or as financial assets. They were identified as individual metals, 200 years ago or so. And they're basically industrial metals. And the bulk of the platinum and palladium has been used in auto catalysts. And that's going to continue to be the situation. So when we look at the platinum and palladium markets, we say there's this race there's a downward race. You're seeing contraction of mine production and total supply. Mine production, partly because of the lower prices of platinum, partly for other reasons as well. But you've seen total supply go from more than 8 million ounces a year down to less than 7 million ounces a year these days, around 6.6 million ounces this year. So you're seeing a contraction in supply, but you're also seeing a contraction in demand, which has gone from like 7.2 million ounces down to about 6.6 million ounces. So you have a much tighter market right now, which helps explain why the price shot up in June and July. But the reality is, from a long-term perspective, what we say is, which is going to fall further faster, sooner? Because if mine production decline outpaces the decline in auto use, then the price will rise. But if auto use declines faster than total supply, the price will fall. And with platinum, you've got two stories with platinum and palladium. They're quite distinct. Platinum is traded between, say, $800 and $1,100 from 2014 until June of this year. It broke above that and it went up to $1,510 or so in July. It did that because there was a marketing group that said, oh, we have a deficit in platinum, which we don't. And you're seeing this massive surge of imports of platinum into China, which is being used in jewelry. Now, you did see platinum imports fall to very low levels in January and February and March of this year. And then in April and May, platinum imports picked up. And if you look at the first half of this year, platinum imports into China are lower this year than they were last year. So there hasn't been a massive surge year over year. There has been a cyclical move where investors and trading companies and users in China were not importing a lot of metal in the first quarter, partly because they were waiting to see what happened with the U.S. new administration coming into the U.S. And then when they saw that in March and April, they started increasing their imports to build up inventories. And what the industry tells us there and what the data tells us there is you've seen imports April, May, June, in line with what we saw in 2024. And a lot of that metal showing up either in Shanghai Futures Exchange inventories or in working inventories at jewelry companies and auto companies and other companies that use platinum and palladium in fabricated products. You're not necessarily seeing consumers buying platinum jewelry. You're seeing jewelers buying platinum, and how much of that is sitting in their inventories is not public information, nor is it very clear, but it seems like a lot of it is actually inventory building by jewelers rather than jewelry purchases by consumers. So that story that came out in late May, that we have a deficit and there's a surge in platinum imports into China and it's going into jewelry, that pushed investors and speculators and some trading companies to build inventories and buy platinum exposure. That drove the price from $1,000 to $1,500. And then by late July, it was pretty clear, by mid-July, it was pretty clear that that actually wasn't the case. And people start unwinding their speculative positions, and the prices come back down to around $1,350 as we speak, right? And our expectation is that the price will continue to move down back into that normalized range, maybe $900 to $1,200. So our ultra short-term view trade recommendation for our clients is, if you're an ultra short-term, i.e. speculative investor, I'd sell platinum today at $1,350 and look to, take profits below $1,300, below $1,250, and you have a similar situation with palladium. You saw the price of palladium got very high into 2021, 2022, partly because auto companies were using more palladium than platinum in their catalysts. That ended after it became clear that the world wouldn't impose palladium trading sanctions on Russia because it attacked Ukraine, and Russia wouldn't use palladium exports as an economic weapon. The price of palladium fell from more than $2,000 in 2021 to $800 to $1,200 by the end of 2023. And it's moved in that range until June. It rose in tandem with platinum June, first half of July. Since that time, it's come back off. Palladium went from like around $900 up to about I think it was $1,370 maybe. And now it's down to $1,140. So it's almost back into that range that it traded in throughout 2024 and the first 5 months of this year. And our expectation is it gets back into that range and moves sideways.
All right. Jeff, I think that covers a lot of it there. Thanks for taking us through platinum and palladium too, and at least your short-term expectations. Really interesting to pull up those longer-term charts for both platinum and palladium. Platinum, you need to go back to 2008 with that spike, but palladium, yeah, not all that long ago that it spiked way up there and maybe is starting to rebound. But hey, overall, interesting comments, and always good to check on the really investment demand narrative and side of the equation for the precious metals. Everyone, thanks for tuning into this weekend show. Hope you got a lot of good information and some good ideas of what's going on in the resource sector. There's clearly a lot more attention in precious metals and other commodities. So hopefully that just carries through to the rest of this year and into future years as prices continue to rise in a more long-term and sustainable effect. Again, Jeff Christian wrapping up the show with us, managing partner at the CPM Group. To learn more and follow along with any of our guests, click the link in the show notes on our website, podcast, YouTube channel, or Substack page. That's where you can also find all our daily editorials and company updates from throughout the week. Jeff, everyone, thanks for tuning in. I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.